Hello. If you're looking at what's going on in Europe with some trepidation at the moment, you're not alone. The fact is that the Eurozone is under a great deal of pressure because of the debts that have been rung up. And the concern now is not just how they're going to pay that down, if at all, but also what happens to the savings of people who've kept their money in their bank accounts. They're already not earning a lot of interest. Are they actually going to get their money back? David Kaur is with me. He is the managing director of the Motley Fool here in Singapore. Hello.
Hello, Mark.
What's the short answer to that? Do you think that if you leave your money in the bank account, it's not as safe as it used to be?
Well, we've seen so many things happening. I think, as far as Singapore is concerned, it's still pretty safe to leave your money in the bank account. But that isn't really what I'm concerned about. I'm concerned about what returns you're going to be getting by leaving your money in the bank account.
Which is next to zero.
Pretty close to zero, yeah, you're absolutely right. What is really happening in the world, Mark, is that the Western economies have accumulated so much debt that they really don't know what to do anymore. If you think about it, there are only three things you can do with debt. You can either service it and pay it down, you can default on it, or you can inflate it away. Now, option number one, which is to service and pay it down, we know they can't do it.
Why not?
Well, because they're accumulating so much more debt. I mean, every time they have another years of deficit, that gets added to the national debt. So that is why the national debt in America, in Europe, in the UK is rising year after year. So option number one, to service and pay down that debt, is a no-goer. Option number two, to default. Well,
default means not pay it back, in other words.
Well, default means I'm not going to repay you back your loan. We know that America, Europe, and the UK will never default on their debts because that is just not an option. So then we're left with option number three, which is to inflate it away.
Well, what do you mean by that?
Well, what I mean by that is that they are trying to reduce the value of their currency and effectively try and inflate away that debt. Now, in real terms, what happens is that if inflation is running at 5%, if I owed you $100, at the end of the year, I will still pay you back $100, but that $100 will only be worth $95 to you.
Because of inflation at 5%.
Because of inflation at 5%. So that is why the West is trying to create as much inflation as they can by printing money. Now, whether you want to call it quantitative easing, whether you want to call it printing money, that is effectively what they're doing. Now, you have to go back to 1970, Mark, to a guy called John Connolly, who was then the Secretary of the Treasury in America. And he told the people about the US dollar, our currency, your problem, right? And that is effectively what's happening today. Bernanke has recently said that the printing of money, the creation of inflation in America is helping the world. Now, he wasn't as cruel as John Connolly by saying our currency, your problem, but the sentiment is there. We're doing this to save ourselves and it's helping you at the same time. But it's not, Mark. It's not helping us at all.
Because inflation obviously flows through to all consumers, doesn't it? So in view of the fact that interest rates are so low, inflation could become a problem again. Arguably in some countries it already is a problem. What does that mean if you ferreted away money into a bank account that currently pays no interest, or you're keeping your money in CPF?
Well, if you put your money into a savings account here in Singapore, you're getting no interest on it.
Well, it's 0.8 something percent. It's virtually nothing, isn't it?
Well, that's right, yes. But if you put it in your CPF, you're getting 2.5%. But inflation is running at 5% in Singapore. The recent CPI figures said that inflation was 4.9%. So effectively, you're losing money. If you leave your money in your savings account, you're getting, you're losing money at 2.5% a year. So it's a bit like, I'm giving you $100 and you tear off a corner every year, and after a period of time, you'll end up with nothing. At 5% inflation, if you had $100, in 10 years' time, that $100 would only buy you $60 worth of goods. So that is what inflation does to your money.
$60 in current days, current terms.
That's right. In today's money, it'll be worth $60. It will still look like $100. It'll still be a $100 note, but it'll only buy you $60 in today's money.
Right. So the $20 trillion question then is, yeah, what do we do with our money? Because if CPF is very safe,
yeah,
even bank deposits are guaranteed in Singapore under the deposit insurance scheme, what options are there for people?
Well, there are only two assets that have beaten inflation over the long term. The first asset is property. The second asset is the stock market. Those are the only two options you have. Now, anybody that's looking around Singapore will realize that property prices are pretty high right now.
Yeah, we read about that all the time. It's
Well, that
quite
is also, one of the consequences of what's happening in the West. Because the West has printed so much money, they can't invest it in the West. So where is that money going? It's coming onto the shores of Singapore. It's pushing up property prices, asset prices in Singapore. So let's rule out property for now. So you're only left with the stock market. So what you need to do is to try and invest your money in the stock market to try and beat that inflation of 4.9%, which you can do with a number of stocks.
But they have to be special stocks, right? These can't just be speculative counters that hopefully will run up, but never actually give you any other returns.
Well, there are many investors who shun away from the stock market because they are concerned that they would lose money, which is where I come from. I mean, I am an income investor, which means that I invest in companies that pay me for owning the shares in those companies. In other words, I want a dividend yield. I want to see every year the company paying me something in the form of dividends, and that would make me happy. Now, if I can get a dividend yield of, say, 5%, then that would already beat inflation. And that is really what I'm aiming for. And if you find a company that is able to increase its dividend year after year, then you have very little to worry about. So let's say, for instance, that I invest $100 worth of stock. I buy $100 worth of stock that's yielding me 5%. Every year, I get $5 from this company in dividends. Now, if this company were to increase its dividend year after year by 10%, this year I get $5, next year I get $5.50. The year after that, I get $6.05. Now, what have I not talked about at all, during this entire conversation?
Well, fluctuation of the stock price. What if the stock price goes down?
Well, I'm still getting $5. So why do I care? And that is the whole point behind investing in income stocks that hold their value. And whether or not the stock price goes up or down is irrelevant to me, because that's locked away in a box. And this company just gives me $5 this year, $5.50 the year after, $6.05 the year after that.
Okay, but there are two problems with this, David. First of all,
yeah.
If you do lock it away in the box, what happens if the company goes bust in the meantime? I mean, there is risk in stocks, and the biggest risk, of course, is that the stock price plummets. Maybe there's some issue, a product recall, a big lawsuit, contract losses. I mean, there is a possibility that the stock price doesn't just fluctuate with the volatility of the market, but actually collapses.
Well, there is a certain amount of company-specific risks. You're absolutely right. If you invested in the company that had a product recall, it depends on how they handle that situation. If they're able to manage it reasonably well, then of course, that will only be a fleeting incident within this company itself. But I mean, some of the other companies you talked about, a company going bust. Well, I think, if I were invested in, say, Singapore Exchange or Semcor Marine or Semcor Industries, I think if that company went bust, I wouldn't be worried about the company. I'd be worried about the state of the Singapore market altogether, yeah.
Right. Okay, so in other words, pick blue chips.
Correct.
Perhaps even we could narrow that down to, let's loosely call them utilities.
Yeah.
Stocks, right? In other words, companies that provide an essential service. I'm thinking of the telcos, for example, where perhaps there's a fluctuation in the stock price. Singtel, perhaps Bharti Telecom in India is not doing so well one year and therefore the stock price falls. I mean, in other words, you shouldn't just pick a company because it pays a high dividend, but a company that also has a sustainable long-term utility-like business model. Fair to say?
Absolutely. I mean, what you are doing is you're trying to sort of pick companies, and even if the dividend yield wasn't particularly high, it doesn't really matter as long as this company has shown a track record of increasing its dividend over time. Because you have to remember that I gave the example of a company that paid a 5% yield and increased it to $5.50 and $6.05 the year after. So what would happen if the company were only paying a 4% yield this year and it was increasing it at 10% a year? $4 this year, $4.40 the year after, and pretty soon it will accelerate to such an extent that it will overtake inflation, which is really what you're looking for. You're looking for safe stocks and try and buy a basket of stocks. So don't just bet your entire amount of money on one stock. Don't bet the farm on one particular company and have a portfolio of shares.
Okay, but that brings me to the second point, and that is that companies in the current economic environment, and we've talked about it so far, Cyprus, US, the fact that China is not likely to get back to the 10% growth rates that it's had in a hurry. In that environment, it's actually very difficult for companies to keep jacking up their dividend payouts, and arguably, companies have actually been cutting their dividend payout. So that's my second concern with income. How do you overcome this issue? And MRT is one example. SMRT has had to reinvest a lot of its money in maintenance, for example. The dividend's been cut as a result. What happens to companies like that? Would you then sell that stock?
Well, when you are selecting stocks, you are looking for companies that have what I consider to be pricing power. Now, pricing power is essential in a high inflation environment. So these are the companies that can increase their prices without even people noticing. Now, moving away from Singapore, let's have a look at a company like Coca-Cola, for instance. It can increase its prices without people even noticing. How much is a can of Coke, Mark?
Well, it depends where you buy it.
Yeah, but how much is a can of Coke?
Well, between $1 and $1.30, maybe.
Precisely, right. So therefore, if it was $1 and the company were to increase its prices by 5%, $1.05, would you notice it?
Probably not, no.
Probably
Whereas
not.
SMRT is locked in by the Public Transport
Yeah.
Council into how much it can charge.
That's right. So you keep away from some of the regulated utilities, and then you look for companies that can increase their prices because they have that ability for pricing power. So another example would be tobacco companies. I know a lot of people shun away from tobacco companies because they are not seen as ethical, but putting the ethics to one side, these companies can increase their prices because they know that their products are in demand.
Right.
So pharmaceutical companies are another one. So there are lots of companies in which you can choose which have pricing power.
All right, and more at your forthcoming seminar during Singapore Investment Week.
That's right. I'm looking forward to that. I think I'm on the 13th of April. Yes, I'm in the morning, so don't forget to turn up, please.
All right, and you can get more information here on this website on your screen now, cs.org.sg/SIW2013. Thank you very much. David Kaur from the Motley Fool. By the way, do you do this income investing for your own
I
finances
certainly
as well?
do, Mark, yes. I mean,
You're not just here talking about it.
I'm not just here talking about it. I practice what I preach. I have a portfolio of about 15 income stocks.
Right, were they hard to pick?
It took a while to build, but that is part of the fun of investing.
But it's also very boring, right? I mean, a lot of people would much rather punt a bit of money on the market. And
Do I look like a boring person, Mark?
well, no, but I mean, a lot of people have a very much more of a trading
Is that
mentality.
what you're suggesting, that I am a boring person?
Somehow, though, boring actually seems quite comforting at the current time, doesn't it?
Yeah, I see it being as secure.